This is xVyperTv and welcome back to the channel. In our last video, we covered how to identify support and resistance zones, spot trends, and use trend lines. But let me ask you something. Have you ever drawn what you thought was the perfect level, only to watch price blast right through it? Or entered a trade based on a textbook setup just to get wicked out before the real move happens? Well, you're not alone. That's one of the biggest pain points I see in newer traders. And here's why it happens. You're using surface level structure without understanding where smart money is actually positioned. In today's video, I'll show you how to identify supply and demand zones, how to draw them accurately, and how to use them to predict where the market is most likely to reverse with precision. Now, before we get started, this video is for educational purposes only. I am not a financial advisor, and you should definitely trade at your own risk. Now, what are supply and demand zones? Supply and demand zones are areas on the chart where institutions and smart money leave footprints. These zones are formed when there's a major imbalance between buy and sell orders, and price moves aggressively in one direction. Demand zone is where buyers overwhelm sellers. Price surged upward. Supply zone, where sellers overwhelm buyers. Price dropped hard. These zones act as launch pads for price movement. When price returns to these levels, those large players often re-enter the market, and that's where we look to trade. Now let's talk about how to identify a demand zone. Look for a strong bullish move, fast, clean candles pushing upward. Go back to the last candle or small consolidation before that push. Draw a box from the low of that base candle to its high. Include the body and wick. That box is your demand zone. Example, price consolidates at 1.1800 for 2 candles, then launches 150 ticks. That base becomes your demand zone. If price returns, buyers may step in again. Now let's go over supply zones. Find a sharp bearish move, strong, fast sell-off. Trace back to the base candles right before the drop. Draw your zone from the high of that candle to the low. Body and wick. That's your supply zone. Example, price forms a tight range near 4,300, then dumps. The consolidation before the drop is your supply zone. If price comes back, that's where you expect sellers to defend. Now let's go over how to draw these zones. Use the entire base candle, body and wick. Focus on the candle before the big move, not after. The more explosive the move out of the zone, the stronger the zone. Best zones often appear at the end of trends or before large breakouts. Now let's clear something up, because this is a mistake I see a lot. Support and resistance are price levels where price has previously paused or reversed. They are horizontal levels based on previous swing highs and lows. But supply and demand zones go deeper. They're not based on structure alone. They're based on volume imbalances and order flow. They show where unfilled institutional orders may still exist. Here's the difference. Support and resistance is where price has reacted in the past. Supply and demand is where price was forced to move due to imbalance. Support and resistance is reactive. You're waiting to see what happens at those levels. Supply and demand is proactive. You're anticipating where smart money will engage. Think of supply and demand as the engine behind support and resistance. One is the symptom and the other one is the cause. Now, why do supply and demand zones work? Institutions can't fill orders in just one move. They create zones where price accelerates out, then wait for price to return later. That return to a zone is where we look for entries, reversals, and continuation setups. These zones are where liquidity lies, not where retail is usually looking. Now we'll go into how to trade supply and demand zones. Wait for price to return to a marked zone. Watch for confirmation, either reversal candlestick pattern, change of character, or a break of structure. Place your stop outside of the zone, and then target the next opposing zone or clean structure area. Now, here on the chart, you can see a clear supply zone. Price consolidates near resistance, drops hard, then returns days later. A bearish engulfing candle forms, signaling the zone is active. A short is taken with a stop above the zone, targeting the next demand zone below. Now remember, not all zones are equal. Prioritize zones with clean, impulsive exits. Zones at extremes often have the best risk to reward. Combine zones with structure, candlestick confirmation, and trend alignment. And also avoid zones that have been revisited too many times. They lose power. Now remember, support and resistance shows where price has reacted. Supply and demand show us why. If you learn to identify institutional footprints, you stop reacting and start anticipating. Now in the next video, we'll cover entry models inside of the supply and demand zones, how to time sniper entries using break of structure and change of character, and refine price action. It's the final piece of the puzzle, and it's where entries go from average to elite. Now, if this video helped you to identify supply and demand zones, hit that like button, subscribe to the channel, and turn on the notifications so you never miss a breakdown. And let me know in the comments, do you use supply and demand zone in your strategy? Or if this is your first time seeing it explained this way. This is xVyperTv. Thanks for watching and happy trading.